Hello everyone. This is a new chapter, the cost of capital. This is not only new chapter but also different perspective. At the first class in this course, I mentioned about two major subfield of finance. The first one is investment, right? In this case, we run the asset pricing, evaluate the stock and bond, right? So investments in financial assets, especially bond and stock, and in this case, RD and RS, these two are represent required rates of return, right? Yeah, as an investor, these two are a required rate of return. But from now, we change to corporation perspective. In the corporate finance, these two, RD and RS, these two are what? Yeah, cost of capital, cost of debt, and cost of stock. So the final cost of capital will be weighted average cost of capital between RD and RS. These two are weighted. So that is here. Weighted average cost of capital. So in this chapter, we are going to run the source of capital and component of cost and the WACC. WACC stands for weighted average cost of capital, and rest part adjusting for flotation cost. Let's start. What source of long-term capital do firms use? Long-term capital can be categorized as this. The first one is long-term debt, and second one is preferred stock. Yeah, we already learned the bond and preferred stock, right? And the equity can be divided by two parts. The first one is retained earnings and common stock. And retained earnings, we also call this as internal equity. And common stock, we also call this as external equity. What is internal equity? It means firm generate equity within the firm. What does it mean? Firm generate equity within the firm, the internal equity. As you can see this picture, when firm invest to a good project, they can generate profit, right? And alpha. The alpha means net income. And then firm can decide two ways. The first one is distribute to the stockholder. We call that dividend, right? And the other way is retain within the firm. So we call that retained earnings. This can be used as internal capital, internal equity. So that is one capital source, right? This slide shows how to calculate a weighted average cost of capital. The WACC stands for this word, weighted average cost of capital. That is the WACC. and the D stands for debt, and P stands for preferred stock. The S stands for common stock. And R refers to the cost of each component. So RD refers to cost of debt, RP cost of preferred stock, RS refers to cost of common stock, right? And there is one interesting is the T. What does T mean? The T means the tax. Tax can reduce the cost of debt. The company will pay less tax. So we can say there is some tax shield effect. So that is related with tax shield. The company pay interest and tax in order of income statement. So I would like to show you one example, the Amazon.com case. This is NASDAQ homepage, and I already searched the income statement. As you can see, there is many accounting items. I would like to show you this one, the interest expense that is related with the RD, the cost of debt. As you can see, when we calculate the income tax, that is multiplied here, earnings before tax. But as you can see, when we calculate earnings before tax, the interest is already deducted, right? So when we use more interest, it reduces this amount, right? So there is some tax shield effect. So firm can have some benefit when firm use more debt. We can write as this part is RD 1 minus T multiplied, right? So we can call this after tax the cost of debt, and when we write just RD, it means before tax cost of debt. And as you can see, the main source of cost is here, right? Common stock, and RP, preferred stock, these two does not have any tax shield effect. So using this formula, you can calculate the WACC. Now we are going to learn how to calculate this RD, cost of debt, RP, cost of preferred stock, and RS. But we already learned before, right? That is required rate of return on debt, required rate of return on preferred stock, required rate of return on common stock, right? So let's run together with some example. This is the first example, the cost of debt. Here, right, RD. The second example is the cost of preferred stock. So let's assume that the preferred dividend per share is $6 and the preferred stock has a price of 50 per share. So we already run the formula of perpetuity, right? Because in US preferred stock, they give the fixed amount of dividend and there is no maturity, so we can apply perpetuity general formula, right? So price of perpetuity can be calculated by dividend over required rate of return on preferred stock, but in this case we can say that is cost of preferred stock, right? So RP, just rearrange this equation, we can write as this: dividend and price of preferred stock. So in this case, dividend is 6 and price of preferred stock is 50, so 12%. So cost of preferred stock can be solved by using this formula, right? Yeah, that is the answer of this slide. And the third example is cost of common equity, the RS. How to calculate the cost of common equity? Yeah, before the midterm exam, we run the two methods to calculate required rate of return and expected rate of return on stock, right? The first one is CAPM. CAPM can be calculated by as this. Capital asset pricing model is R risk-free rate, market risk premium multiply the beta, right? And this one can be calculated by market return minus risk-free rate. And that is the general formula, right? And DCF method, the current stock price can be determined by dividend at T1 and RS minus G, and we can rearrange this equation. RS is equal to D1 over current stock price plus G, right? So using this formula, we can calculate RS, right? If the risk-free rate is 7% and market risk premium is 6% and the pound beta is 1.2, what's the cost of common equity based upon the CAPM, the capital asset pricing model? Just write down the equation one more time. RS is equal to risk-free rate market risk premium multiply beta, right? So input the numbers here. 7%, market risk premium 6%, beta is 1.2. Finally you get the numbers 14.2%. That is the answer of this question. This approach is using CAPM, and second one is using DCF method, discounted cash flow method. So we already run some equation using this. RS can be calculated by D1 P0 plus G, right? And D1 can be calculated by D0 multiply 1 plus G, right? And P over P0 plus G. And you input the numbers here, right? 4.19 multiply 1.05, and current stock price is 50, and dividend growth rate is 5%, 0.05, and then you get the final number 13.8%. This slide summarized our result when we used CAPM method. The RS, the cost of common stock, is 14.2%, but when we used DCF method, discounted cash flow method, we get the different number, right? 13.8%. Which one is right? Yeah, DCF, it is more restrictive because DCF assumes dividend grow at a constant rate, and if this assumption is not proper, we just use CAPM. But if it has both are pretty much accurate, we can take an average. So this number, it just comes from average of this. Finally, we can calculate the WACC. We already calculated these numbers, right? And you put in the numbers. Finally, you get 11.4%. So when ignoring flotation cost, this pumped WACC is here, right? And I will explain flotation cost at the next slide. What do you think about the implication of the WACC? When WACC is used, it's weighted cost of capital, so it is used when firm decide to raise your money. So it can be used as a cost of capital concept. And the second, it can be used as a benchmark. So let's say 100 million one-year project, and suppose WACC is this number, 11.4%. If this project return is 10%, for example, the project return is 10%, it is not enough rate of return using this money, right? When you use this money, we should pay 11.4%, but project return is less than cost of capital, right? So in this case, we can reject, right, the project. So WACC is useful tool when we determine the project whether good or not. So this would be benchmark of the investment project. So we will learn this part at the investment policy part. And now we learned how to calculate WACC. We use cost of debt, cost of preferred stock, cost of common stock, right? How about the cost of retained earnings? The cost of retained earnings exists or not? If they exist, which is smaller, the cost of retained earnings or cost of issuing new common stock? In this case, we can answer it's not cost per se, because the firm generates equity within the firm, right? So there is no cost itself, but as an opportunity cost perspective, it's cost. So we can write down as this, as an opportunity Why? Why, as an opportunity cost perspective, retained earnings is cost? Go back to this slide. Big picture of the corporate finance. corporation generates some money and they have some alpha, right? The net income. Firm can choose two ways: distribute to the investor, stockholder, that is dividend, or retain their earnings. We call that retained earnings, right? So if firm does not use retained earnings, shareholder can receive more dividend, right? And have an opportunity to reinvest the dividend. This can be reinvested, right? However, firm did not pay out the dividend. In this case, firm retained all the net income, right? Shareholder lose opportunity to reinvest the dividend. So the cost of retained earnings must be at least equal to shareholders' rate of return on reinvestment of dividend paid by firm. So we can conclude that it's not free money when company use retained earnings. And the second question is, which is smaller, cost of retained earnings or cost of issuing new common stock? What is the answer? Yeah, cost of retained earnings is smaller than the cost of new common stock. Why? Yeah, this has the issuing cost. We also call this the flotation cost. Flotation cost. I explained flotation cost. When firm issue the stock, there is some issuing cost. They have to pay flotation cost to who? The underwriter. The flotation cost in Korean 발행 비용, and underwriter in Korean 주관사. So most of case, the IB, the investment bank, play a role as an underwriter. Flotation cost depends on types of capital being raised and firm's risk. And one more thing is flotation costs are highest for common equity. Why? Stock valuation is more difficult because it is hard to forecast the project would be a success or fail. So firm issue common equity, they should pay more flotation cost to underwriter. Did you see flotation cost in bond? A bond is less risky than stock. So compared with the stock, flotation cost of debt is little. So flotation cost for debt is usually ignored. Even for stock, a lot of case we don't know the flotation cost. First, we ignore that when we calculate the WACC. But if it is given, you should use that. Here is example. If issuing new common stock incurs a flotation cost of 15% of the proceeds, what is the cost of common equity? So using DCF method, RS is current dividend multiply 1 plus G, and denominator is current stock price, right? And G. But in this case, the flotation cost is exist and we know that. So multiply 1 minus F, 1 over 1 minus F. Yeah, that is the general formula when there exists flotation cost. So we can highlight as this part, right? And then you input the numbers. Finally, you get the cost is 15.4, right? It is higher than this, right? Because we consider flotation cost, so cost of common equity increase. The last slide. What factors influence a company's composite WACC? The WACC, the general formula is here. The WACC is weight of debt, cost of debt, and 1 minus T. T is the tax rate, right? And WP and RP, right? Preferred stock. And some firms does not have preferred stock, so we can take the parenthesis. And weight of common stock, cost of common stock. What factors influence a company's WACC? So we can write as this. The first one is tax. Tax is here, right? So tax can affect the WACC. And the second and third and last one, these three related with three major decision of firm. What was that? Do you remember? Financing decision, we can say capital structure, and second one is investment decision, and last one is payout decision. For example, investment decision. Suppose that firm invests only in risky project. What will happen to cost of capital? It's future projection of cash flow, right? So you can think as an investor. If the project fails, you cannot pay back the interest and principal. So firm invests more in risky project. You require more higher return, right? So required rate of return increase. It means the cost of capital increase, right? So we can conclude that the firm's future decision affect firm's future WACC. And also we can say firm's future WACC affect the firm's future decision. There's a circular relationship. Second half of this semester, we will learn more deeply about these three major decisions. Thank you.